Hello and welcome to the weekly roundup for the weekend in Friday the 19th of March. Hope that you're enjoying these weekly reports. Please do subscribe to receive regular stock market content. Any questions as well, pop them in the comments box below. Love to hear from you. Finally, as always, I'd like to invite you to follow the free stock market reports on tech, banks, IPOs. In fact, pretty much what is current and live in the markets. Again, just use the link in the descriptions below. So this week, principally, it was all about the central banks. The big games in town were the Fed and the Bank of England, although there was also meetings for the Bank of Japan, the Bank of Turkey and Brazil as well. But neither the Fed nor the Bank of England were expected to adjust their policies. Investors were really more focused on the outlook and the take on the recent bond market rout. So with the Fed, they now expect the US economy to grow by an eye-watering 6.5% this year, well above the previous 4.3% forecast. And US inflation is also expected to tick higher to 2.4%. However, the Fed considers that inflation above the 2% target will be temporary. They doubled down on their accommodative stance in the meeting. Despite the huge upgrade to growth, they also said it was unconcerned by the rise in bond yields. Yields have since surged to fresh 13-month highs. Stocks have come off their record highs, and tech stocks, which are particularly sensitive to the interest rate outlook, fell as well, sort of paring off those gains from earlier on in the week. So the Nasdaq looking to finish off the week 0.4% negative, S&P 0.7% negative, and the Dow has gained 0.2%, supported by the cyclical stocks. Over in the UK, the Bank of England also kept rates unchanged and adopted a cautiously optimistic tone regarding the outlook for the UK economy. Although again, the Bank of England did say it was in no rush to start tightening monetary policy. So the pound against the dollar set to finish the week pretty flat, while the FTSE looks to actually be booking losses of 0.8%. Over in Europe, really the focus there has been on the vaccine distribution issues and the concerns over the AstraZeneca jab. The European Medical Agency confirmed yesterday that the AstraZeneca jab was actually now safe to use in their eyes after several EU countries suspended the use of the vaccine on blood clot fears. European exchanges were seemingly unaffected by the slow vaccine rollout and the rising cases in Europe. Really for most of the week. It only really came under pressure today as we saw a little bit more news seeping out. But the DAX has powered to all-time highs. Again, just being supported by cyclical stocks and particularly automobiles. So the DAX is actually up 1% across the week. Concerns, however, over the resurgent COVID and vaccine issues have been more evident really in the value of the euro, which slipped below 1.19 against the dollar. In the commodities markets, oil's taken a hammering, no better way to put it. It's down across the week, standing at over 9% lower. Combination of disappointing inventory data, rising concerns over the COVID resurgence in Europe have just unnerved the oil traders. Renewed lockdowns in parts of Europe have dampened hopes of a quick bounce back in demand. So we actually see West Texas Intermediary back under $60 a barrel. Gold is now on track for a very mild weekly gain of 0.5%. The rising bond yields act as a drag, but this is being balanced out by gold's status as an inflation hedge. Into the stocks, what we have seen here, big moves for Volkswagen. They surged over 40% this week after setting itself up as a main rival to Tesla. Its battery-focused Power Day on Monday and the promise of 6 gigafactories. In addition to this, plans of a 1 million electric and hybrid vehicle. So this has left investors suitably impressed, sending the stock on a bit of a run. Meanwhile, Tesla dropped over 5% across the week on the back of the prospects of increased competition and sell-off in the broader tech market. Greggs down 4% across the week after booking its first loss since going public. Sales fell by a third owing to COVID lockdown restrictions, which turned the once busy cities into nothing more than ghost towns. But even so, this crisis is expected to be temporary, and Greg's planned to open 100 new stores across the year. In the US, Uber's taken a bit of a hit. They're down 7%. They've lost a key legal battle in the UK High Courts. So they now must classify its UK drivers as employees with paid sick pay, paid holiday pay. Not too good for the company, but great for the employees here in the UK. That's pretty much it, really. So thank you very much for watching.